It's a good idea in times of market volatility to review the things that generally work in the investing world. On the weekend in the Globe Investor magazine, Rob Carrick summarized the 10 commandments of investing. And over the next couple of sessions of Toron Investment Insights, I'll present some of those commandments to you. The first commandment comes from a fellow named David Draymond, who runs Draymond Investment Management in New Jersey. And David says, investors repeatedly jump ship on a good strategy just because it hasn't worked so well lately, and almost invariably abandon it at precisely the wrong time. This comes down to an issue of using short-term performance to judge the effectiveness of a long-term strategy, when really, in theory, what people should be doing is looking at the long-term strategy and trying to determine whether it makes sense and whether it will meet their objectives over a long period of time. A great example of that is since May of 2007, it would have been extremely difficult for a portfolio of globally diversified securities to outperform the Canadian marketplace, given the headwind created by the strengthening Canadian dollar. It's strengthened by almost 15% over that period of time. Does that mean that the notion of investing globally in stocks is a bad idea? No, not really, and especially when you consider that option relative to investing in a Canadian market that's essentially dominated by two themes. Over time, it makes far more sense to be invested globally and to diversify your risks across a number of industry sectors and geographic regions, as opposed to focusing on a concentrated region, but short-term performance would certainly have led you to a different conclusion. The second tenet of investing that Carrick points out comes from a fellow named James O'Shaughnessy, who was the author of a 1996 bestseller called What Works on Wall Street. And O'Shaughnessy says, investors who look only at how a strategy has performed recently can be seriously misled and end up either ignoring a great long-term strategy that has recently underperformed or piling into a mediocre strategy that has recently been on fire. In general, short-term performance is driven by a concentration in a certain theme or in a certain strategy. If an investor has 80% of their portfolio in gold stocks at a time when the metal rises from $450 to $600, chances are they're going to outperform the broader market and perhaps every other industry subsector over that period of time. If an investor has all of their money in financial stocks, when interest rates fall, they'll likely do very well. But what happens if the opposite event occurs and gold falls or interest rates rise, or we see the turbulence in the financial sector that we've seen over the last 3 or 4 months? Concentrating a strategy is almost never a good idea over the long run, and that's what's so ironic about O'Shaughnessy's quote, and the fact that what works in the short term does not necessarily guarantee future success. The next of Carrick's tenets that I'll highlight comes from Sir John Templeton, founder of the Templeton family of mutual funds and longtime manager of the Templeton Growth Fund. And Templeton says, invest at the point of maximum pessimism. Very apropos, I think, if you think in terms of the markets today and how things feel to most investors. One of the basic tenets of value investing is to buy low. And there is almost never a better time to buy low than when the market is full of pessimism, and in fact, when people are actually panicking. That doesn't mean that you can just buy anything, of course. You need to do your homework, and ideally investors during periods of volatility will do that homework so that they know what stocks they want to buy in the event that they do fall to prices that are appropriate and attractive. In future installments of Toron Investment Insights, I'll delve further into some of the tenets that Carrick puts forward as his 10 commandments.